In a brief exchange in the comments section on one of my recent videos, I mentioned to a subscriber that starting in the late 1990s and up to about the year 2000, I was primarily a buyer of silver, with the objective that I would eventually trade it for more gold than I would have obtained if I had simply bought gold over that entire time period. Then in early 2011, I was presented with an opportunity to execute my trade, and I exchanged thousands of ounces of silver for gold at a gold-to-silver ratio in the low 30s. It wasn't something that I was saying for the purpose of bragging. It was something that I was saying to demonstrate that I think that silver is perfectly okay to own, and I owned it myself in quantity for a long time. The subscriber asked for some tips. I did learn a lot from executing that silver for gold trade, and so I thought I would pass along some tips for anybody who's interested. Tip number 1. Find a good broker and develop a relationship with them. You should get to know their names, and they should get to know you. Take the time to talk. This obviously will work best if you have a local coin shop and can just walk in. There's a pretty good local coin broker located downtown for me. I got to know when the quiet times were, when I could just walk in and talk to Doug and Pat, the people who ran the retail arm of the business. We'd talk about current events. They would give me gems of information such as what they thought were the factors driving metals prices and premiums at the time. They would tell me when business was booming and when it was slow. They would tell me if more people were buying or more people were selling. I liked them. They liked me. Most importantly, they knew that I always honored my commitments. I didn't always come with my checkbook in hand, mainly because I knew that I didn't want to ever feel pressured to buy. But when I offered to buy some metal from them at a certain price, I would always show up the next day with check in hand to buy at the agreed upon price, whether the price moved against me or not. Because of this, they kept my name in their Rolodex and started calling me when someone came in to dump a significant amount of silver or gold. They would offer it to me at a price that was only a few percent over what they paid the seller. It was a really good arrangement. Now, you may or may not have a local coin shop near you. If you do, get to know them well. If not, then I'd suggest whenever you buy metal online, you call the customer service department rather than just putting in an online trade. By doing so, you will obtain something just as valuable as the metal. You will obtain a relationship. It will provide you insight and give you access to news and offers that you otherwise wouldn't be able to get. Tip number 2. Be very mindful of premiums. Most of the time in the community, we focus on spot price. The spot price is the easiest piece of information to obtain online, but unfortunately, it's not the most relevant information if you want to be successful at building wealth using the gold to silver ratio trade. What you need to do is buy metal that has the lowest spread. This will almost never be the prettiest and most interesting coin. Generally for silver, it's going to be the larger generic bars and pre-1965 US coins, often referred to as junk silver. The premiums over the buyback price will fluctuate for these items as well. It's critically important to purchase when the spread is less than 10%, and the closer to zero you can get, the better. Again, if you have a relationship with your dealer, you'll be able to take advantage of deals because they will come to you when they have metal that they need to move. Tip number 3. Write down the factors that will cause you to pull the trigger on your trade. At first for me, when I was a novice buyer, I had it in mind that I would execute my trade when the gold to silver ratio dropped to 16. I'm very glad that I studied the metals as much as I did, because I completely changed my thinking. If I had stuck with 16 as the magic number, I would have completely missed the opportunity that presented itself to me in 2011. I came to realize after years of studying the numbers that there does seem to be an equilibrium spot price that tends to prevail. This equilibrium value, according to my work, is about 63 at present. Unfortunately, this doesn't give the person who owns silver in the hopes of trading it for gold much guidance in terms of when to pull the trigger. Silver is a very emotional metal. When it moves, it tends to move quickly. When the gold to silver ratio drops, it can spike down and only stay there for a brief period of time. There is no easy way to predict how low it will go. 16 is not the magic answer. So what is the answer? Short and simple, it's psychology. I wrote down all of the factors that I would need to observe to know that it was time to execute the trade. The number one factor was that it would have to be at a time when I would feel very, very bad about doing it. I would have to strongly suspect that I would be kicking myself a few weeks after selling. The second factor was the rate of change of the silver price relative to gold. I resolved that if the gold to silver ratio changed by more than 10 points over a short period of time, that I would have to be ready to pull the trigger. And the final factor was the behavior that I observed in the buyers of silver. If my contacts at the coin shop were telling me stories of large numbers of new novice buyers coming to their store with unrealistic goals, it would surely be a sign that a top was imminent. When the time came in early 2011, all of the factors were there. It was time. Now, I had to fight the urge to hold on, but fortunately, there were other factors going on at the time. For example, very often there would be new silver YouTube channels popping up just about every day talking about how silver was the secret to becoming rich. Now, taking note of all of these factors allowed me to execute my trade pretty close to the top in silver. I didn't like executing that trade at all. It felt wrong. But in hindsight, it was successful. Tip number 4. Keep all of your receipts. Yes, that's right. I want you to keep your receipts. It's more than just for the purpose of being able to pay your taxes should your broker issue a 1099 to the IRS. I have noticed over the years that there are laws starting to pop up in my state. I don't need to show my ID to my broker because they know me so well, but I've seen them require some sellers to show them ID. I found out that it has to do with the state cracking down on theft. The broker wants to be prepared to help the authorities trace the source of stolen goods. While it runs counter to the need for privacy, it is something that I can understand. But it also demonstrates something important, and that is that laws can change. There may come a time in the future where sellers of precious metal will have to demonstrate that they came by the metal honestly. If you've accumulated metal over the span of years, you'll want to be in a position where you can prove that it's yours if you have to. Now, this is a just-in-case measure. It's better to have the receipts and not need them than to need them and not have them. This isn't to say that there won't be a black market somewhere where you'd be able to sell your metal. There always is. But don't expect to get the best prices on the black market. Now, the final tip, tip number 5, and this is by far not the least important of the recommendations, is to be patient and have realistic expectations. The ratio trade that I executed took more than a decade. In fact, it was close to 15 years from when I started buying silver to when I traded the majority of it for gold. When you trade gold for silver, or silver for gold, you won't want to be doing it often. The gold to silver ratio can fluctuate by 20% or so on a fairly regular basis. And if you're using real physical metal for the trade, it won't be profitable for you because the spread on your metals will eat your profits unless you have a very large change in the gold to silver ratio. In fact, if you don't carefully track the actual prices at which you bought your metals, you may trick yourself into thinking that you're getting ahead when in fact all you're doing is making the retailer happy. It's best to wait for big moves in the ratio. I'm talking about moves that will increase the amount of metal that you own by a factor of 50% to 100% or more. Now, these are the profitable moves. You may see 1 or 2 of them over the span of your working life. This is one of the reasons why I'm sticking to gold for now. Silver is a very volatile metal, and I'm no longer in the gold to silver ratio trade game. I don't have sufficient runway ahead of me. Maybe you do. If so, then this video was specifically for you, and I hope you found the advice useful. If so, please take a moment to give the video a thumbs up, and feel free to ask questions in the comments section.